You wake up and check your phone. The headlines are jubilant. The S&P 500 has hit another record high. The GDP grew by 3% last quarter, beating expectations. Unemployment is at historic lows. Economists on cable news are celebrating a soft landing, cheering for the resilience of the American consumer. By every traditional metric, the economy is booming. The machine is working perfectly. Then you close your phone and go to the grocery store. You pick up a carton of eggs, a gallon of milk, and a pound of ground beef. You look at the price tag and you feel a distinct tightening in your chest. You pay, and it costs 20% more than it did 3 years ago. You drive home, passing a gas station where the prices have crept up again, to an apartment where your rent just increased by $200 a month. This is the dissonance of the modern American experience. It feels like a form of gaslighting. You are being told repeatedly and with data to back it up that the country is richer than ever. Yet you, and almost everyone you know, feel poorer. You are working harder, your side hustle has a side hustle, and yet the goalposts for financial security seem to be moving further away. This isn't just in your head. It isn't just vibes. It is a structural reality. The reason you feel poor in a rich economy is that the word economy no longer means what you think it means. We are measuring the engine's RPMs, but we aren't checking to see if the car is actually moving forward for the passengers inside. To understand why, we have to look at how the machinery of wealth detached itself from the reality of work. For the decades following World War II, there was a golden rule in American economics. As the country got richer, the workers got richer. It was a lockstep relationship. If productivity went up, meaning workers produced more stuff per hour, wages went up by the exact same amount. A rising tide actually did lift all boats. Then, around 1973, something broke. The lines on the graph diverged. Productivity kept climbing, computers, automation, and globalization made us more efficient than ever. We produced more value in an hour than our grandparents could in a week. But wages? They flatlined. This is known as the Great Decoupling. From 1979 to 2020, net productivity rose by roughly 62%, while the hourly pay of typical workers grew by only 17%. So where did the excess money go? If you made the pie bigger but your slice stayed the same size, who ate the rest? It went to capital. In economics, there is a constant tug-of-war between labor, the people who do the work, and capital, the people who own the assets, the factories, the intellectual property, and the stocks. For the last 40 years, labor has been losing. Corporate profits hit record highs, not despite your stagnating wages, but because of them. Every dollar not paid to a worker is a dollar retained as profit. The good economy the news talks about is an economy of capital. It measures how well corporations and assets are performing. If you own a lot of assets, if you have a massive stock portfolio or own 3 rental properties, this economy is indeed fantastic for you. But if you earn your living through a paycheck, through labor, you are living in a completely different, much harsher economy. But the stagnation of wages is only half the story. The other half is the cost of survival. You often hear that inflation is cooling, but inflation is a tricky beast. The government measures it using the Consumer Price Index, a basket of goods that includes everything from flat-screen TVs to bananas. And sure, thanks to global supply chains, televisions and toys are cheaper than ever. But you can't live in a television. The things that have skyrocketed in price are the things strictly required for a dignified life: housing, healthcare, education, childcare. These are the non-tradable goods. You can't outsource your apartment to a factory in Vietnam. In the 1980s, the average home cost about 3 times the median annual income. Today, it is nearly 6 to 7 times. Healthcare costs have outpaced inflation by huge margins for decades. A college degree, once a ticket to the middle class, is now a debt sentence that shackles young professionals for decades. This creates a paradox. You might be able to afford a better smartphone than a billionaire had in 1990, but you cannot afford the security that a factory worker had in 1960. You are technologically rich, but asset poor. You have cheap entertainment, but expensive survival. When economists say the economy is growing, they are often looking at aggregate spending. But if that spending is just you paying more for rent and insurance, that's not prosperity. That's just churning money to stay alive. High GDP can sometimes just measure the high cost of being poor. There is one final, invisible engine driving this wedge between the country's wealth and your wallet: the financial system itself. Whenever the economy stumbles, like in 2008 or 2020, the Federal Reserve steps in. They lower interest rates and print money to keep the system afloat. This is quantitative easing. The goal is to stimulate the economy. But how does this money enter the world? It doesn't get mailed to your mailbox. It goes into the financial sector first. It goes to banks and corporations. This creates something called the Cantillon effect. Those who get the new money first, the investors, the bankers, the large corporations, benefit the most. They use this cheap money to buy assets, stocks, bonds, and real estate. This buying spree drives up the price of those assets. The stock market booms. Real estate prices soar. If you own assets, you get richer without lifting a finger. This is why the stock market can hit an all-time high while food banks see record lines. But for you, the person trying to buy a home, this asset inflation is a disaster. The cheap money that made the rich richer made the house you want to buy unaffordable. The recovery was K-shaped. The top arm of the K went up: assets, stocks, corporate profits. The bottom arm went down: wages, savings, and purchasing power. So to answer the question, why is the economy good, but you are poor? Because the metrics of a good economy were designed for a different era. GDP does not measure distribution. The stock market does not measure the health of the working class. Low unemployment does not measure the quality or stability of jobs. You are poor because the link between your productivity and your pay was severed. You are poor because the cost of essential services has exploded, while the cost of luxury distractions has collapsed. You are poor because the monetary policy designed to save the economy acts as a wealth transfer mechanism to those who own assets at the expense of those who earn wages. This is not a glitch in the system. It is the current design of the system. The economy isn't broken. It is doing exactly what it is incentivized to do: maximize return on capital, not return on labor. Recognizing this is the first step. The numbers on the screen are real, but they aren't your numbers. The economy is booming. It just isn't booming for you.